Thank you for joining us today for our Zoominar with Andy Ann of Waratah Capital. My name is Jeff Hunter. I'm a portfolio manager with the Townshend, Somani and Hunter Group at Canaccord Genuity. Also on the line is our lead investment advisors, Dave Townsend and Raheem Somani of Canaccord. For more information about our team, please check out mywealthmanager.ca. Before we get started, a couple of housekeeping items. We have muted participants, but in the chat below, feel free to direct any questions to Dave, Raheem, or myself. We'd be more than happy to ask on your behalf. Today's call is being recorded, so make sure to check your emails in the coming days for the replay information, or follow our team's Facebook page at facebook.com/mywealthmanager.ca. With that said, let's get started. Andy, can you tell us a little bit about Waratah Capital and what you focus on?
Great. Well, thank you for having me, Jeff. I certainly look forward to taking everybody through who we are and our differentiated approach. I'm just going to share my screen and the presentation first. Just wanted to confirm that everybody can see the presentation here. Right on. Great. Well, so I guess for those who don't know what a Waratah is actually a flower that's native to Australia. It's got very deep roots and can survive wild brush fires. We feel the flower embodies our investment philosophy. That is, when market sell-offs happen and wipes everything out, a Waratah remains resilient as we navigate through the turbulent markets. The firm was founded by Brad Dunkley and Blair Levinsky. Brad was previously a long-short equities manager at a large Canadian investment firm, and his partner Blair was ex-investment banking on the mergers and acquisition team. The two started Waratah in 2010 with 25 million of their own capital, with the objective of not losing their money and to compound their wealth over time. Fast forward to 10 years later, today, we're one of Canada's most recognized investment management firms, with almost 1.8 billion in assets under management and 116 million of which are founder and employee capital. We're invested right alongside our investors, and we like to eat our own cooking. Page 4 is a slide on our suite of offerings. For 10 years, we've been recognized for consistently delivering sleep at night returns to our investors. And we're also recognized as being good managers of risk. Today, I'll be focusing more on the Waratah Alternative ESG Fund. It's Canada's first and only long-short ESG strategy. We've been running the strategy since November of 2018. Most of you may remember the fourth quarter of 2018 was not particularly a great time to launch a new fund. The markets were down over 12% for the quarter, but we were pleased to see Waratah Alternative ESG protect investors' capital right out of the gate, being down only 0.3% in 2018. In 2019, the fund finished the year up 18.6%. And this year, it's up 10.5% as of June 30th. As you can see here, it's averaged about 17.5% per year over the last year and a half, with approximately half the risk or volatility of the markets. Moving forward, we expect the fund to deliver between 7 to 9% over the long term per year, again, with approximately half the volatility of the markets. It was originally seeded with our internal capital and a handful of our investors, but today the fund is available to a wider audience, and you can certainly touch base with either David, Jeff, or Raheem if you're interested in learning more. So I guess on page 5 talks about our ESG journey. Our ESG journey really started in 2016. One of our institutional investors came to us and asked if we can transform one of our existing funds into an ESG fund. After much deliberation and thinking, we decided to take a more genuine approach, staying true to our DNA of being fundamental, bottom-up investors that's focused on risk. Our answer was to create our own framework and dedicate a fund just to ESG as opposed to greenwashing one of our other funds. And what we came up with was the Waratah Alternative ESG Fund. And the fund's mandate is to make money while doing good. Before we dive into our unique approach, maybe be helpful if we clarify a few things, and specifically what ESG means. I'm sure most of you have heard it before, but ESG stands for environmental, social, and governance. It's a set of factors that is imposing a secular change to how businesses operate and how investors invest. Most of you have probably heard it on the news. Companies, including energy companies like Synovus, are adopting sustainable practices to reflect the needs and values of doing business in today's society. Done correctly, it can have a tremendously positive impact to the bottom line. Done poorly or ignored, companies often find themselves struggling to stay in business. Now, there's a few different ways to approach ESG investing. Traditional ESG mandates that's been around for a while are normally long only and are often exclusionary. For example, they don't invest in tobacco, they don't invest in cannabis, certainly not oil and gas, many of them. And they're more on the right-hand side of the spectrum. Their investments are driven off of their values as opposed to being value-driven. And this type of responsible investing is actually called impact investing. They put the social impact ahead of fundamentals. The Waratah Alternative ESG Fund is not that. We're more on the center left side where we aim to make money while do good. Every basket, thematic, and company in the portfolio has to be in there for fundamental reasons and ESG reasons. So, what is our approach? Leveraging 10 years of fundamental research, investment, and risk management experience, we married that with our proprietary ESG scoring framework, which we developed in-house, and we have a team of ESG analysts whose job is to score each individual company. And we arrived at our internal ESG integrated approach. Firstly, how we score companies is unique and dynamic. We weight the environmental, social, and governance factor differently for each sector because it just doesn't make sense to apply the same scorecard for an oil company the same way you would apply a REIT. For an energy company, the environmental aspect could be a much bigger part of the ESG score, whereas for a REIT, the social and governance aspect could have a bigger weight in the score. And after we score a company, what we arrive at is a company ESG score, and that ranges from -3, which is bad, to +3, which is good. Our integrated ESG approach allows us to reward and support companies that are fundamentally strong with sustainable ESG practices. We call them the good actors. And we punish the opposite, the bad actors. So companies with poor ESG practices and deteriorating fundamentals. What's interesting about the fund is that the entire portfolio must have a positive ESG score. So we get points for supporting a good ESG company, and we also get points for shorting a bad one. I would say this has allowed us to identify new opportunities and be better managers of risk. All of this leads to a consistent, steady, absolute return stream, and the numbers speaks for themselves. The fund was up in February and March this year. As you can remember, in Q1, the market sold off. Our short positions in the bad actors contributed positively to performance as those companies saw their share prices decline precipitously. For example, cruise ships, which are notoriously pollutive, is now undergoing an existential risk. We didn't know the pandemic was going to happen at the time, but we were short cruise ships leading up to February and March because they were so poorly run from an ESG standpoint, and we saw that translate into negative impacts on their margins. So when the market sold off, we made a lot of money on shorting cruise ships. And in the second quarter, the market was completely different. It rallied in the second quarter, our long positions. So the good actors with sound ESG practices and solid fundamentals, those companies rallied, and we ended up playing some solid offense in the second quarter. Year to date, the fund is up 10.5%. So how is the fund built? The fund takes a multi-manager approach. Internally, we actually call it the All-Stars Fund. All of Waratah's top portfolio managers, that's Brad Dunkley, Janine Lee Chong, Adrian Wong, they all run a basket, and the lead portfolio manager is Jason Landau. Each portfolio manager has his or her own basket or baskets, and a basket can focus on either a sector or a thematic. For example, potable water is currently a thematic in the fund. We call it the water basket, and it invests in companies that are trying to solve for the availability of potable water and to address the issue of an aging municipal water infrastructure in some more developed metropolitan cities like New York. There's currently a massive tailwind behind the sector, and we believe it only pick up from here. Now, as mentioned before, the portfolio must have a positive ESG score, and each basket must also have a positive ESG score. This page highlights some of the has some of the highlights on the strategy, and specifically it focuses on how we construct the portfolio. We have strict risk management protocols in place. For example, our gross exposure, which is the top number right here. A gross exposure is just simply the total value of all your long positions and the total value of all your short positions, and you add them up. That cannot exceed more than 200%. Our net exposure, which is just taking all the long positions and subtracting the short positions from it, this number roughly gives an indication of the fund's exposure to the general market. The sweet spot for the fund has been around 30% to 50% net long. On average, historically, it has run about 40%, which is right down the middle. At only 40% net exposure to the market, it certainly has punched above its weight class during market rallies and avoided the big drawdowns during the sell-offs. Each company in the portfolio can be at most 5% of the weight. Each basket can be most 40% of the gross capital. We also have basket stops in place as well. If a basket declines by 5%, the basket gets cut in half. If the basket is down more than 10%, we shut the basket down. And once again, at the bottom, every basket must have a positive ESG score. So that's how our portfolio is constructed in our unique long-short approach to ESG. But before I kind of share an outlook on the market and give an update on how the fund is currently positioned, I'll end off on a case study, Husky Energy. Husky is known for its oil spillages, employee fatality counts, and non-independent board. Chinese billionaire Li Ka-shing has a significant amount of influence over the board, and the company frequently engages in corporate transactions that is beneficial for him, but detrimental to the other shareholders. All of this erodes the business's fundamentals. For these reasons, we scored Husky a minus 1.7 between -3 to +3. Now, what's interesting is that third-party ESG scoring companies scored this company positively. There are currently a handful of third-party ESG scoring companies out there. Examples would be Sustainalytics or MSCI, and most of them arrive at conflicting scores. One company would rate something positive, while the other would rate it negative. This would be the same as if S&P and Moody's had two different ratings on a company's bond. Many of them also use AI technology to pick up keywords, but companies are getting smarter. They're hiring consultants to greenwash their reports so that the AI can read it and rate it more favorably. This is actually where we find opportunity. We do our own homework. We have our own team of ESG analysts that apply our dynamic ESG framework, and we actually speak to the management ourselves and hold them accountable. So going back to Husky, Husky is a short in the portfolio for both fundamental reasons and ESG reasons. The thing we have to be careful of is if Husky is a short and oil price rallies, the short can potentially hurt us. This is why we also have on the long side higher quality energy companies with good ESG practices, for example, Cenovus. Our thinking is if a company is trying to do better, why shouldn't we support it? By having a basket of good oil companies on the long side, we can essentially hedge out oil risk. And what you're left with is just isolated negative ESG alpha, which internally we call ESG risk. So the key takeaway for this case study is that we do our own homework, and that allows us to identify opportunities, generate alpha, and mitigate risk. So hopefully by now, you'll have a better understanding of what ESG is and what ESG means to us. Maybe for now, we'll take a step back and we'll take a look at what the second half of 2020 might have in store for us and how we're positioned in the fund. So far this year, we've seen a COVID-driven sell-off in the first quarter, followed by an epic rally in the second quarter, fueled basically by unlimited government and central bank stimulus. We believe all of this stimulus and shift in global supply chain to be inflationary in the long run. It's difficult to say where we'll go from here. Markets can either melt up or it could retest lows. What we do know is the markets are very much bifurcated right now. All stocks generally fall into two camps. You're either a growth stock, which recently have become synonymous with certain work from home themes. So think Microsoft, Zoom, cloud software, etc. Or you're either a value stock. So think reopening names, restaurants, theme parks, refiners, banks, retail real estate. The fund is currently taking a balanced barbell approach. It has growth names that will continue to do well in this era of low interest rates and work from home. If we have a faster than expected reopening with either a vaccine or whatnot, we also have exposure to companies that will benefit from that reopening. Reopening winners are theme parks and select restaurants currently in the portfolio. The fund also has portfolio insurance in place by way of put options on various market indices. In the event of a sudden and drastic sell-off, we expect the insurance to pay off and will dampen some of the drawdowns like it did in February and March. I would say moving forward, integrating ESG factors into our analysis continues to be very beneficial. It opens our eyes to emerging themes that were present prior to the pandemic, as well as new issues that are developing as we come out of lockdown. For example, the S of ESG, which is the social factor, will become more pronounced with topics like sick pay, health coverage, wages coming into light. Will companies need the same floor space as they did before, or would hoteling concepts be the norm? Will businesses travel ever return to prior levels, or has Zoom changed the way we do business? These are all the things we think about on a daily basis. All of this translates into the Waratah Alternative ESG Fund being a dynamic, all-weather solution that can protect your capital and be a conservative return driver in your portfolio. If markets rally from here, the fund is positioned to deliver solid returns. If we retest the lows, the fund aims to avoid capturing the big drawdowns. Now, at the end of the day, investors will experience sleep at night returns. And in the long run, investors end up at a much better place if they protect their capital, and they do so with a much smoother ride. On the next slides are a few appendices, primarily our scoring process. I guess on this page walks through step by step on how one of our ESG analysts would score a company using our proprietary scorecard. And this is an example of the real estate proprietary scorecard. We would have one for every single sector. Now, without getting into the details, the environmental has a 40% weight, social has a 30% weight, and governance also has a 30% weight in the real estate sector. And also there are subsectors that are specific, or subcategories that are very specific just to real estate. And we would have one of these scorecards for every single sector: discretionary, consumer staples, utilities, and certainly real estate and energy. So I guess at this point, I'll turn it back to Jeff to see if there's any questions from the team or the audience.
Yeah, just in terms of going back to the shorts, we've seen some hot pockets in the market, which have been pretty notable with some pronounced valuations. What are your steps, and when you're talking about risk reduction, can you short things that are improving but have just been had a blow off top and look stretched? Where do you guys sit in terms of positioning with valuation risks?
Sure. I guess the benefit of being both a long and short fund is that while valuations continue to be an issue, or especially in 2019 when valuations were an issue, we could take long positions in companies that one would think is priced highly, but we can also short companies and we take short positions in companies with even higher valuations. So on a relative basis, valuation becomes less of a concern for the fund overall, especially as we saw in last year as we entered the late stages of a very long tenure bull run.
What kind of sectors do you seem to be overweight right now? Where are you seeing the biggest changes in ESGs? Where do you see the biggest opportunities in growth? And on that, what companies, within that framework are making major steps towards moving towards this and are seeing that in their share price?
Sure. For example, I would say right now, in terms of thematic that is catching on, one of them was mentioned in the presentation, was the water thematic. Solving for potable water is a global issue, and also addressing the aging municipal infrastructure. The efficiency of delivering water all the way to the consumer's taps is right now very inefficient. A lot of it gets leaked out. So there will be big tailwinds that would support that thesis. For example, Evoca Water Technologies is a company that was a positive contributor to performance in the past quarter. And this fund would be able to identify opportunities like that and take advantage of certain opportunities. And using our ESG lens, we would be able to see things that, for example, would often be missed by a traditional long short equity fund that doesn't apply an ESG lens.
Where do you see your investment landscape? Is it mostly North American based? Do you guys have access to international markets and emerging markets? Where do you guys specialize?
Well, that's a good question. I would say the fund is predominantly North American. However, it does have the flexibility to go. A lot of these issues that we're seeing today, whether it's environmental, it's global issues, and opportunities are again global. For example, the electrification of vehicles movement is very much pronounced in China and also in Europe. North America is actually 10 years behind in terms of the electrification of vehicle development. So by having that flexibility to move outside of North America, especially for an ESG fund, is actually very helpful. And we foresee a lot of opportunities moving forward on the international front.
So given that, how do you guys view and trade currency risk? Do you guys use it as a support and a buffer within the portfolio, or do you trade around that as well?
No, so all our funds, including the Waratah Alternative ESG Fund, we hedge our currency 100%. So the returns we delivered at the end of the day to investors, currency wouldn't have any sort of play into that.
Now, on your option strategies, do you go long? If you're speculating, can you take just pure calls or puts or anything along those lines, or are they mostly a core position and then managing risk around that?
Sure. I would say our option strategy is very much, it's an actively managed option strategy, but the main purpose of it is to reduce risk in the portfolio. For example, we would buy put options, which is synonymous with portfolio insurance on various market indices that our equity may have exposure to that we don't want. And we can either buy straight out protection or we can do it in a more cost-effective way of buying insurance that are a bit closer to the money, a bit closer to the expiry date, and selling insurance way out there. This is a much more cost-effective way of doing it, but historically it's done very well in times where the market has a sudden drawdown, for example, like we saw in February and March. The portfolio put option strategy that's there for risk management purposes really helped protect some of that downside and contribute to performance.
Just on that, given that you're a long short, what's your net exposure to the markets? Do you have a kind of a comfortable range that you sit within? Does it swing dramatically? Can you go negative exposure to the market? What are your guys' views there?
Yeah, sure. So comfortably, the fund, the sweet spot for the fund is between 30 to 50% net long. Historically, it's run on average 40%, which is, again, right down the middle. The constraints there is we can go up to 75% net long, or we can go 75% net short. But again, historically, it's been between 30 and 50% that's the comfort range for the fund. Now, there were times where when the market sells off drastically, the options really do kick in, providing that downside protection. And the portfolio was able to go from a net long position of say 30% down to a net short position very quickly, very actively. And basically, when you're net short the market as the market's falling, that's great for performance. And it's actively managed. And when the market's down 10%, we don't want to be net short the market at that time, at which point the active management kicks in and we would take some of that portfolio insurance away or slowly layering them away so that we can be better positioned to adapt to new information and changing markets. Like we saw in on March 23rd, actually, markets went down, our fund was up, the put options kicked in, and then we became more constructive. So the net position grew, and our gross position grew as well, and we were able to play some solid offense as the market rallied in the second quarter.
Are you seeing bigger shifts and movements in demand for ESG south of the border or in Canada? Or when you're looking at your portfolio right now, how much is Canadian based? How much is US based and otherwise?
Yeah, no, that's a good question. I would say in terms of ESG, from an investor perspective, we're seeing a lot of it come from institutions, actually. Specifically, when we created our framework, we spoke with a few institutions out in Scandinavia and Europe. Now, the ESG scene and the institutional scene, at least, out in Scandinavia, they're much ahead of North America in terms of what they do and how they do it. And they really like our long-short approach to make money while do good. They've seen traditional long only that only excludes certain things. That's a bit more of the past. The long-short approach is definitely a more unique approach that resonates with investor bases over there. But in terms of how the fund's positioned, I would say it's roughly balanced right now between North America, between Canada and US. Maybe it's tilted a little bit towards Canada for now.
Andy, I got a couple questions for you here. What's the total assets under management for Waratah currently?
Sure. For Waratah, as a firm, we just had our 10-year anniversary actually last month. And we're at 1.8 billion under assets under management.
And what, in terms of principals and management employees, how much of that is comprised of their capital?
Approximately 7%. So 116 million is founder and employee capital. So that's, we like to have a significant amount of skin in the game, and we're invested right alongside our investors.
A couple things. ESG, very topical. Today you had Tesla, Elon Musk saying that he wants to utilize nickel that comes from companies that mine environmentally friendly. Do you think that Elon Musk and Tesla is reactive in nature to the market, knowing that they're a focal point in terms of the base out there of investors? Or would you suggest that they are more of a leadership type of company and want to maintain that edge versus other rivals in space? It's a little bit more of a, I would say, what your opinion is more versus what Waratah's position could be.
Sure. Again, it's hard to know what Elon Musk is thinking on a day-to-day basis. It seems to change all the time, but we would say, Tesla, and I would say Tesla in general, at the end of the day, they're great at making cars, but they're a battery company. And the electrification of vehicles is and will be a big, big theme in the world as we come out of it. For example, during COVID, companies, for example, like GM, they've actually shifted more of their research and development budget, 60% of it, towards electrifying their fleet. Volkswagen, Daimler, they're all following suit. A lot of the government stimulus that we've seen during COVID, they're actually targeted towards the development or subsidies of the electrification of vehicle movement. So I guess in a nutshell, electric vehicles are here to stay. It's difficult to say what Elon thinks, and lithium batteries is kind of what we believe. And I think there's also a lithium battery lithium basket within the fund as well, to take advantage of some of that electrification of vehicle tailwind.
That's a good answer, and I appreciate that. What's driving ESG, do you think? Do you think it's millennials per se? Do you think it's, good corporate stakeholder governance? Do you think it's a combination of all three? Or do you think it's just human nature now becoming less spirited by just pure capital and more in terms of making money or being aligned top to bottom? I see institutions that are asking those questions, and I see individuals. We have a number of prospective clients and institutions, and they always ask what our positions are, what our thoughts are. I'm going to turn that question to you. What are your positions and thoughts? And can you see this across all of Waratah's funds down the future, having a full mandate where ESG is a component?
Sure. No, I think that's a really good question, and it's very applicable, I guess, for today's webinar and also in today's society. Bottom line is, we think ESG is here to stay. Whether that's driven by millennials who will inherit a lot of wealth in the upcoming decade, and they become the decision makers on how they want to invest, they will certainly have a say. But on the other side, we also believe ESG is good business. It's good practice, and having sustainable and responsible ESG policies in place is profitable. For example, like cruise ships, as mentioned earlier, they continuously to ignore, government regulations, warnings on dumping, and they dump the gray water, which is just wastewater, right into the ocean. And they continue to get fined and slapped with fines by regulatory bodies. And you're seeing those fines having a negative impact to balance sheets. So, ESG, whether it's more of a flavor of the day or a sentiment, it really does have business impact and impacts the balance sheet. So for those reasons, our fund, we look at opportunities both from a fundamental perspective. It has to make sense fundamentally, but also from an ESG perspective as well. And I guess to your second question, I almost forgot. I would say with ESG, through the ESG lens that we applied here today, we're actually seeing some of the mentality and discussion spill over into our other funds. Now, we don't want to greenwash our other funds by any means, but the analysts and the PMs that are running capital and some of the other mandates, what has nothing to do with ESG, they're starting to think as well, hey, no, this is right. There are certain tailwinds in the sector. This is a profitable investment, and we should look into this. So I would say the idea and the philosophy is really spreading to the other funds as well.
Perfect.
Just on, you touched on lithium companies and kind of triggered something. Where do you, what kind of limitations in terms of market caps and sizes of companies can you participate in? Do you have full flexibility, full range? Where do you start viewing companies in their fit?
That's a good question. I would say, our size right now, the fund it just started in November 2018. The fund is at 50 million in assets under management, I think maybe as of this week. And by being a smaller, more nimble fund, it allows us to take opportunities that other larger funds, if you're running $1 billion, you wouldn't be able to take advantage of certain opportunities. You wouldn't be able to have a meaningful impact to your portfolio. For example, the IPO of Chewy last year. It was a big contributor to performance, and we were able to take advantage of that and still fall within our risk management guidelines. What we can invest in, the size of the companies most often have to do with our self-imposed liquidity rules. For example, we have to be able to get out, reduce the portfolio down by half within 3 days, by 80% within 4 days, and effectively to zero within 5 days. Now, if all the companies you own are too small, or there's not enough liquidity, we can't do that without having a negative impact to investors. So we want to be mindful of liquidity. We certainly want to be mindful of the size of the company. But right now, being, call it a newer fund, it certainly positions early investors for potential outsized returns, especially in the early years of the fund.
And with that, can you participate in things like financings and private placements within there?
So no, the fund, is focused on publicly traded investments, public traded equity specifically.
Raheem, do you have anything else to touch on?
Nope. I believe this is this also offered as an alternative fund for non-accredited investors, Andy?
It is. It's offered as a liquid alt. So the minimums to buy are, it starts at 5,000. And we're seeing a lot of people start allocating this across their books and starting to be a core holding to a lot of both accredited investors and non-accredited investors alike.
Perfect.
I agree with the alt funds have really improved the ability to manage risk and have that short side option and have the liquidity within it, as opposed to the old mandates where you were locked in for a few years. It took at least a month to get out after holding it for that time period, with less flexibility and often quite significant initial investments, sometimes and often in the six-figure ranges. And so I think it's a great way to, if you really care about the ESG space, to dip your toes into the water and ease into it and start participating that way, as opposed to taking on too much risk in terms of an individual position itself as an overall portfolio. Well, Andy, I really appreciate your time. Thank you for joining us today. Hope everyone enjoyed it. Looks like we're having another decent day out there today, so especially thank you. It's given us a little bit of your summer to spend some time on these emerging investments. Thanks again, everyone, and enjoy the rest of your day.